itemized deductions. For the people who can itemize their deductions, very few people get to deduct medical expenses on their tax return anyway. Because of the income limitation you have to get over to be able to deduct it in the first place. 7.5% of your adjusted gross income is a pretty high number to start with. And they raised it to 10% in 2019. So very few people got this deduction to begin with. Even fewer are going to get it now, just because that income limitation is hard to get over. On your itemized deductions, you were able to deduct state taxes you paid to the state of Indiana, property taxes, excise tax on your vehicles. You can still deduct all of that if you're able to itemize your deductions. But there's a caveat. The caveat is it's capped at $10,000. So depending on what your tax situation is, how much money you make, what your property taxes on your house were, in 2017, if all of that added up to be $20,000, in 2018, it's going to be capped at $10,000, no matter what that number is. Now, again, people are going to say that this is a bad thing. And it may or may not be. It all depends on your individual situation, because depending on how your tax return worked, you may not have been getting a full deduction for that number anyway. So being capped at $10,000 is not in and of itself a bad thing. It all depends on how your individual tax return works. For people who have a $1 million mortgage on their house, which is all of us, no, okay. You can now only deduct $750,000 mortgage on your tax return. There again, this affects a very small portion of our population. This one is affecting people because the IRS has now broken apart basically your first mortgage and your home equity line of credit. In the past, we would say, use your home equity line of credit to go buy a car because you can deduct the interest on that. Not anymore. So the home equity line of credit can only be used, you can use it for anything. The question is can I get a tax deduction for it? As long as you use it to buy, build, or improve your primary residence, you can still deduct that interest. But if you take out a home equity line of credit on your primary residence and you go buy a rental property, or you go buy a condo in Florida, or you go buy a car, that interest is not deductible on your tax return anymore. And how they, everything up here, I've had somebody at some point in time come up with a yeah, but issue on it. How the IRS is going to police this is when you get a 1098 from your mortgage company now, there's going to be a whole lot of more information on that form than there used to be. So they're going to report what property actually secures that line of credit. They're going to report when that mortgage was taken out. They're going to report when the original loan was taken out and how much it was for. So the IRS is going to get information to try to back into what this money was used for, whether it was used for your primary residence or used for another purpose.